the four of us are here gathered today to try to convince you guys and make this panel absolutely worth your time. So for all of those who are attending in person, thank you so much for your attendance. And yeah, we're going to, again, do our best to try to make sure that this is actually worth the full 45 minutes. And I am very confident that we're going to be able to do that. Let's start with a quick show of hands. How many people own Bitcoin? All right. Hopefully that's 100%. How many people own a Bitcoin ETF? All right, maybe like 50% of the way there. How many people have heard about a bank or worked at a bank where, let's say a few years ago, just the mention of Bitcoin would have been outlawed and banned, but has since then kind of done a full 180 and now have a bunch of these like digital asset teams building out products and services? Most of you guys have kind of heard of those things? Cool, cool. Well, look, that I think is like the perfect encapsulation of just the transformation that we've seen over the past 2 years in terms of digital asset market adoption and infrastructure. That's pretty much going to be the panel. We're going to go into a variety of different subsegments and subtopics as it relates to market structure, and we have amazing luminaries and panelists here to kind of guide us through the conversation. But before we do that, I have just kind of this opening monologue where I'll go into pretty much a little bit of the landscape and some of the things that I myself have been noticing. So my name is Nuri. I am BitGo's Chief Product Officer. I've been with the company for approximately 5 years. We work on everything ranging from wallets to custody, staking, trading, borrow, lend. We even have a stablecoin tokenization platform. And from my perspective, we're very, very lucky because we are a picks and shovels company. We're at the ground level of building all these fundamental building blocks for a bunch of other institutional players to effectively build on top. So we do have a real good sense of what is real and what is just purely effectively in the bylines on, let's say, CoinDesk or some of these news syndications. But definitely from my perspective, the number one thing that we've noticed is that there is absolutely unbridled optimism and ambition from a lot of amazing teams building all around. So let's actually get into where we actually are today. So about 7 months ago, Bitcoin reached all-time highs at approximately $126,000. Today, I think we're probably hovering at about $76,000 or about a 40% drawdown. Despite this drawdown, I think many of us in this room, and definitely folks at this conference, would probably feel very confident in the following statement, that despite the drawdown, the institutional adoption and just the overall rigor and pace of the industry has been better than what we've ever seen before. And I would really say it's kind of a variety of different things that are coming together. The first the first thing that I would probably key everyone's attention to is really just U.S. spot Bitcoin ETF flows. Today, I think it's about approximately 1.3 million units of Bitcoin in these ETF products. That's about 6% of circulating supply in products that didn't exist a few years ago. So that by itself is just absolute testament to folks like Matt and Matt's team for building a lot of these fundamental financial products that should exist. The other kind of landmark story that I would say is the amount of Bitcoin that also sits on exchanges is also at a historic all-time low. So what that again means is that it's not that these Bitcoins have actually disappeared. They've fundamentally rotated into better products in the shape of either ETFs, some of these Treasury companies as well, just to name a few things. The second thing that I'll highlight is TradFi is definitely here to stay. Last week, or maybe about 2 weeks ago, we saw some announcements from Schwab. Schwab is officially entering into the landscape. Not only Schwab, but Morgan Stanley as well is staffing up and building out effectively crypto trading directly into their applications. And these guys aren't just building pilots, they're actually looking to staff and bring to market full-fledged products, which I would say is, again, a noticeable difference from where we used to be approximately a few years ago. And then the last thing that I'll probably highlight is if you zoom out and think about the global kind of landscape right now, definitely the other really big notable change is, quite frankly, the regulatory framework that we've actually just seen in the United States first and foremost. So we finally have the Genius Act, which gives a kind of principled framework for how to think about stablecoins and how to think about reserve management, transparency, things like that. We also have effectively the Clarity Act, which tries to tackle market structure. I would say probably the Clarity Act has a probably more difficult task because it fundamentally now has to think through what is a security, what is not. It also has to think through jurisdiction, what is regulated by the SEC versus the CFTC. And of course, the missing piece obviously is actually implementation. One, getting these things passed is one Herculean task, but the more important thing is to actually get this thing executed across all the players within the market. So net, Where are we right now? So as a quick summary again of the landscape, institutional capital is definitely arriving despite the 40% drawdown. Two, the inflows have been meaningfully rotated into other products like ETFs, like Treasury companies. TradFi is entering the landscape in full force. And then last but not least, we finally have a regulatory framework that allows us to reason about digital assets in a meaningful way in the United States. So the fundamental question for the panel today is, what kind of market are we actually building? That's what we're here to talk about. And with myself, I have four amazing leaders and titans of the industry that have different perspectives on how to actually think about market structure and how it's actually evolving over the next few years. Rather than me reading effectively a bio, I'm just going to have everyone pretty much introduce themselves. So please tell me a little bit about who you are, what you do, and the thing that really sticks with you as you think about market structure over the next few years. So we'll start with Igor and then make our way to Alex, Matt, and then Sean.
Thank you, Nuri. Hi, everyone. Good afternoon. My name is Igor Istratov, and I lead digital assets at Fifth Third Bank. And my experience and background is in managing and building crypto and digital assets product within large financial institutions, including SoFi and JP Morgan. And something that I stay up today at night and then think about all the time, like where we're moving, is the gap between where the digital assets are today and the infrastructure that supports them. And then the day-to-day routine that I'm like getting through is like how to narrow that gap for the clients of the Fifth Third Bank and bring the digital assets into the traditional banking stack.
Thanks. Well, I'm Alex Blume. First of all, I'm so grateful to be a part of this panel with some really smart people and just to be involved. So thanks for that. Two Prime is a Bitcoin financial services business. We are a SEC registered investment advisor and a commodity trading advisor, a broker dealer, lots of licenses, and I would say we focus on solving Bitcoin problems for institutional clients. Historically, we've traded a lot of derivatives to generate Bitcoin-based returns. We started doing Bitcoin-backed lending. We've done about $3.5 billion of Bitcoin-backed loans over the last 24 months. But really, every client, we have bespoke institutional clients. So every client has different needs, and we're more focused on understanding those clients and solving those problems, and not, it's not a cookie cutter single solution. And as the market changes, those solutions change as well.
Amazing. Matt Hougan, I'm the Chief Investment Officer at Bitwise. We're a global crypto asset manager. We manage about $15 billion across ETFs, staking, SMAs, vaults, and other strategies. Specific to this room, we run one of the larger Bitcoin ETFs in the US. We donate 10% of the proceeds to open source developers, and the largest Bitcoin ETF in Europe. The thing that strikes me about market structure is just how much it's improved. Many people have been in crypto for a long time, right? Might remember the first time Bitwise came on the scene was when we wrote a report for the SEC showing that 95% of all crypto trading volume was fake. So to go from that to where we are today, even though there are miles to go, we've made a lot of progress.
Yep, Sean Bill from Bitcoin Standard Treasury Company, previously at Blockstream as the Chief Investment Officer there as well. Really just trying to be a positive catalyst for kind of the financialization of Bitcoin into the financial ecosystem. We raised about $5.1 billion on our last deal, which will be public, I think, in June. And what we're trying to really do is we're really trying to build that kind of the Berkshire Hathaway of Bitcoin. So kind of a Berkshire Hathaway 2.0. And so what I'm really excited about is trying to, find ways to use Bitcoin as an asset to generate a return and to really kind of, take it to the next level.
Awesome. Thank you for those intros. So yeah, let's get right into it. And the first kind of topic or probably round of questions will be directed to Matt. The institutional appetite for Bitcoin has been absolutely like one of the breakout stories, as evidenced by the ETFs. So you have ETFs, you have wealth platforms, wealth managers, investors beginning to allocate a meaningful size to Bitcoin-related products. From where you sit, where does the institutional appetite actually look like right now? And where do you see like the next wave of product development really going from here on out?
Oh, great question. So on the appetite, you haven't seen anything yet. That's my net take. It is just really starting to ramp. I'll share a few statistics around that. The average Bitwise client allocates to our ETF after 8 meetings. If you know financial advisors, doing meetings on a quarterly basis is a fast cadence. That means someone who wasn't prepared to buy a Bitcoin ETF when it first launched is just now getting through that process if they've been moving as fast as possible. By that, I mean, I think you're going to see inflows ramp substantially over the next 3 to 5 years as not only Bitwise, but BlackRock and Morgan Stanley and everyone else goes through this process. I'll share one other stat. Yesterday, I was at a normal advisor conference, not a crypto conference. And I started my speech by asking the room how many people own Bitcoin in their personal accounts. There were 170 people in the room. 150 people raised their hands. That is extraordinary. 2 years ago, that was like 10 or 12 people. Now, only about 20 of those advisors had it in client accounts, but our journey at Bitwise is that it's always PA first, and then it's in client accounts. The other statistics that I'll share, and then I'll talk about new products. The gold ETF is probably the best analogy. Gold ETF launched in 2004. It was the second fastest growing ETF of all time, pulled in $3 billion. The industry went crazy. It had increased flows in year 2, 3, 4, 5, 6. And then its biggest year of flows was year 18. So I think we'll eventually get to the point where Bitcoin ETFs are pulling in $100 billion a year. And I think that'll be a few years from now, but every piece of data tells me we're going in that journey. In terms of new products, on the ETF side, you're going to see index and thematic products take a bigger share. You're going to see things like the Goldman Sachs Premium Income ETF, where they're doing option overlay strategies on Bitcoin, take a bigger share. I would say that income-oriented activities and then thematic index activities are the next wave. But by far the biggest wave is just this Bitcoin wave. Just remember that 8 meeting statistic. For what it's worth, people wonder when central banks will allocate. They also take 8 meetings, but they only meet with you every year. So that will take like 8 years. It's this continual flow, but it's almost a rule of adoption is it takes 8 touches, and you just have to see how long that takes.
Can I ask a quick follow-up to that? What are they asking you in those 8 meetings? What is the pushback to the adoption?
Yeah, the first thing is they start from a real position of skepticism, so they don't know why Bitcoin is worth $0 or $1 versus $0. They need to understand its fundamental value. If you can convince them of that, they then want to go through a journey of understanding how it works. They want to understand how proof of work works. They want to understand how transactions work. Then they want to learn about custody and make sure that you can keep it safe, and then that you can trade it. Then they want to talk about the valuation that it could get to. Then they want to talk about where it fits in a portfolio. And finally, in the 8th meeting, they want to talk about where to allocate. It's always that same thing. This is junk. Oh, okay, maybe it's interesting. How does it work? Oh, how much could it be worth? How does it fit in a portfolio? And then how do I actually do it? That's sort of like the shape of the journey. And then periodically, depending on the FUD of the moment, they'll do an extra meeting where they're like, what about quantum? And that will set you back by 6 months. So that's what happens too.
Yeah, I would add to that because, back in 2019, I made a formal recommendation to our pension fund that we put Bitcoin on the balance sheet. And that came out with 1 to 3% allocation. And back then, they would look at you like you had 3 heads. Like, what's Sean trying to do? Like, he's going to get us all fired. And my consultant did get fired eventually. But by 2021, we were able to get it done. And so to your point about all the meetings, it's like, we did, I think at least, it was about probably 2 years worth of work of like bringing in, different folks to speak. We had Matt at Sackers, the State Association of California Retirement Systems. We try to bring in folks that, will put on the suit and we'll actually, talk about why it's a good to add Bitcoin to the portfolio. And, it's hard to find back in those days. But now, like the last Sackers I went to, we had standing room only. We had over 600 people in that room. And, those folks in the past, we might get 200 and they put us in a side room. So it is kind of changing. They're interested. I think the endowments and the foundations are a couple steps ahead. They're already there. And I think this stuff with the ETFs is a great way for them to kind of get into the space. And then now all these new products like the yield products and stuff like that will just make it more and more attractive.
That's awesome. Thank you both. Next one is for Alex, slightly related. So definitely like from the two prime perspective, like you guys are obviously into trading as well as a variety of different strategies. From your guys' perspective, like obviously you guys are a much more like sophisticated institutional player and service provider that is able to execute these things. Is there anything that's currently missing in, let's say, trading infrastructure or just fundamental like building blocks that prevents you from getting to even more scale?
I can think of a number of things. One is I think you have a really bifurcated market with actual Bitcoin and then ETF Bitcoin. Both have purposes and uses, but there's separate exchanges to trade them. There's different rules around margining, and there's not a lot of connectivity between the two in some cases, except for groups like us that can open accounts at these places and make money. And so in some sense, I don't mind it staying a little fractured, but it's still a very fractured market. So I would say one is, especially around derivatives, there are not platforms to execute trades or manage orders or manage a portfolio. At Two Prime, we've had to build all that stuff from scratch. You can talk to groups and they say, oh, we have 70% of that, and maybe we'll build the rest for you one day. And just, you can't run a trading firm like that. Also, you have just reporting and tax and audit and now these 1099 DAs, all that stuff. There's not, you have to patch all these things together to service a client in an institutional way. And so that's hard. That's a big barrier to entry, I think, for a lot of people. Further, there's prime brokers, some that'll trade Bitcoin options with you. There's some traditional ones that'll trade dollar-denominated options. And there's none that really touch all of the exchanges where you can run strategies that cross across that. And with the regulatory environment, it's also still complex. Deribit is over 90% of the options market, and you cannot be a U.S. company or even a U.S. person in the United States trading to access it. And so there's billions and billions of flow, and then what you get is U.S. groups that can set up those offshore accounts and just fleece you on OTC options prices instead. And so I think as that stuff comes together, it means it gets harder to arb across different products, but for more institutional access, I think that this is what needs to happen.
That's a great answer. This is for the general population, by the way. Less related to the topic of trading, just more related to like where we see the kind of industry headed in like 2 to 3 years. So, you kind of highlighted how despite there being a lot of progress, it still requires you to like build a bunch of like direct integrations and manage all the orchestration to be able to route trades, et cetera. As we see more institutional players arriving, like the Schwabs, like the Morgan Stanleys of the world, if we really zoom out like 2 to 3 years, what's this like panel's like general take? Like, are we going to see like heavy consolidation where we see like a handful of like really, really big TradFi names win? Obviously, there are also like crypto native firms that might actually supplant some of the TradFi names. Or do we end up in this like other world where it's just hyper fragmentation of like we just kind of stay in this like wild west period of like everyone offers a little bit of what feels like it's the same, but it's actually a little bit different. Curious what people think about this.
I can take that one. I think that we're going to see consolidation, but not in the way everybody can imagine consolidation. The consolidation is going to happen at the access level. So with Schwab, with JP Morgan, with the Fidelity coming into the institutional space offering digital assets, we're going to see them absorbing the access to the digital asset space for the platform because the general population and the retail side of the business is going to get access to the digital asset space through the traditional interface and the platform that they manage other digital assets and traditional assets like side by side. But the liquidity in the back is going to continue to have a certain fragmentation because with Schwab powering this sub-custody, with Paxos and Morgan Stanley is powering it from a zero hash perspective, we're going to see that fragmentation of different liquidity pools, and then they're going to come together. So the real winner in that game is the infrastructure providers that are going to be powering that institutional adoption for the platforms that are going to consolidate the access to the digital asset space for seamless experience. And the winners are going to be the firms that can have a seamless backend that is compliant with the audit, regulatory requirements, risk, and then can execute the platform execution and settlement in a seamless manner without any slippage. And we're going to see that adoption in the next 2 to 3 years.
Great answer. Now we'll focus in on Sean. So Sean, you are you obviously represent Bitcoin Standard Treasury, and definitely Treasury companies have been an amazing innovation, I would say, over the past year or so. Folks like me, the optimists in the room, would probably call the Treasury company as quite frankly, a very important element of market structure. The naysayers in the room might kind of rebut with like, well, they're like these wrapped equity vehicles. But from like your perspective right now, like just given where these treasury companies sit, like what are they actually meaningfully doing for market structure? Do we actually have reasons to believe that maybe it's actually introducing like risk that's a little bit opaque or something that we're not able to like actually think through? Like, what are some of your thoughts?
Well, I mean, I do think that there was definitely a hype cycle and there was definitely a blow off top in the summer. And I think there's a lot of carnival barkers out there, right? And so you do have to pick and choose. I think in our case, I think we're relatively unique. We have Adam Back, unparalleled deep domain expertise in the Bitcoin protocol. We have myself, running institutional multi-billion-dollar portfolios for decades, public track records, and top decile. So we bring a little different approach. I think, like to my earlier point, we're really focused on really trying to be a positive catalyst in the ecosystem. We want to try to utilize Bitcoin as an asset. And when we started researching that, what it really led us to was that, we think there's space for kind of a Berkshire Hathaway of Bitcoin, and to use the Bitcoin as the asset where they use stocks and bonds. There's a lot of implications in that, whether the insurance space and what have you. We'll touch on that because I don't want to give away our playbook, but we will be there. We are also looking at other verticals. So we look at it as like you have to have individual swim lanes and individual alpha engines. So we have, covered options trading strategies like what 2Prime would do. We have, basis trading strategies. We have high frequency trading strategies. We just bought a shop out of Switzerland, one of our affiliates, that just does nothing but high frequency. So we're really focused on, trying to kind of, push the ball forward. When we did our de-SPAC process, we actually did the first Bitcoin in kind equity pipe, which had never been done in the United States. And that was a prerequisite for us. We said we want to bring the Bitcoin to Wall Street. We are not going to Wall Street just to harvest fiat and convert it into Bitcoin. We're actually going to we seeded it with 25,000 Bitcoin from our stash. We put the Bitcoin in kind equity pipe out there, which raised another 5,000 Bitcoin. And we've got plans to do more Bitcoin denominated notes. And so I think that's another thing as you see Bitcoin moving off exchange and it's not as easily accessible. I think that's where we have a real advantage over our competition, is we have the credibility to pull big slugs of Bitcoin from the audience.
I would just add there. Well, I was talking to somebody the other day and saying strategy they talk about yield. And I was saying, I don't think it's really yield, considering it's the riskiest possible thing you could describe. And he said, you don't get it. It's a company of Bitcoin strapped with a hedge fund on top of it, arbing its own stock. I was like, okay, that doesn't sound like yield to me. But when I hear about, I think describing something as a Berkshire Hathaway of Bitcoin, that I think makes sense, right? As I'm going to take some risks of a management team and some extra expenses to try to achieve something beyond just holding Bitcoin. And I think that's a really reasonable thing, a set of risks to take, and I think represented well. And I guess I'd be curious to ask you, when you think about how a group should measure if you're doing a good job, is it Bitcoin per share? Is it operating income? Is it Sharpe ratio? Like, how do we know if you're doing a good job?
Yeah, so I do think it is initially going to be, the market's focused on Bitcoin per share. I think as we begin, so another piece of our strategy is to consolidate the industry, right? And to acquire other companies that are Bitcoin focused. So one of our other sister companies, another Blockstream entity, has probably 90 different, venture capital investments with several $billion invested. So only Bitcoin companies. We don't mess around with Ethereum. We're not interested in Solana. Let the other people play with those casino chips. We stay focused on Bitcoin. And so I think you'll see phase 2, phase 3, we'll start rolling out acquisitions and start rolling up companies. So that could change the metrics,
Yeah, I almost feel like there's a product that should exist, which is like the coin market cap, but for like all these companies that are generating yield, and like you have some of these metrics that you propose. That way you actually have transparent information around these things. Because otherwise, like everyone just has to do a bunch of research. Everyone is on X. Everybody is using Perplexity to try to do this by themselves. And I feel like in that like without this transparency, you just end up again with like a bunch of risk that the system just doesn't fully actually understand and process. Thank you for that answer. All right, back to Igor. Okay, so from a regulated bank's perspective, what is the like one clarification or like the one kind of limiting constraint or factor that would most immediately change bank adoption and how they approach digital assets? So like the general theme here is like, if you had a wand and you can just like solve any particular problem, any particular objection, maybe it's a technical thing, maybe it's a regulatory thing, like what would it be? And if that objection effectively gets eliminated, like how big and how quickly can this thing actually grow and get adopted amongst banks?
I think in the banking industry in general, I see the general theme across all of the banks is risk labeling as an issue. And I'm just going to use yield as an example of risk labeling, right? Even with the Clarity Act and the Genius Act that is going to ban yield, we are not going to wake up one day and say like, okay, yield doesn't exist anymore because it's banned by Genius Act. It's going to exist. It's going to exist in DeFi pools. It's going to exist in offshore venues. It's going to exist in the different forms of treasury strategies. And then I think like from the banking perspective, it's actually not a bad thing because we're going to clearly delineate the payment products from the investment products. And the payment products are going to have a clear line of management from the risk perspective, because if we use stable coins for the cross-border payments, for the settlements, we don't want these stable coins to act like an investment instrument. On another side, like if we're going to have a clear set of investment products that act like securities and can be regulated like an investment instruments, it's great too, because we have the clear governance path for both. And risk labeling is important because with yield moving into the different paths, like yield is not one thing, right? We cannot just ban yield as a whole, because yield can be promotion on the existing holdings. It can be a reward. It can be a return on deposit. It can be money market-like exposure. It can be DeFi credit risk. And all of these type of risks labeling, they need to exist because they're completely different and they need to be regulated differently. And then we need to build a different set of governance for each of these risks. So risk labeling is one of the things that we would like to see the clarification in the next 2 to 3 years to see the next wave of adoption of digital asset space in the banking industry.
All right. Thank you for that one. Back to Alex this time. So on the topic of yield again. So yes, in general, like these yield products are coming online, and maybe like the just like most pressing question for myself is like, as these yield products come online, like what materially changes? Like, should we expect less investment into spot Bitcoin, less investment into ETFs as an example, and rotation into these other products? Or is it kind of like what Matt said earlier of like, no, it's like they're really going to start investing on that 8th meeting. So like that, like we're still going to see a tremendous inflows of spot Bitcoin, ETFs, et cetera. But if we fast forward again a few years, like is it going to be dominated by a bunch of these different yield strategies, and like we as an industry have to grok like what is safe yield, what is consistent like sustainable yield versus like high risk yield? Like is that what the industry turns into, or is it still like largely Bitcoin spot ETF dominated? And again, like I'm sure like the world is probably going to be a little bit of both, but like curious like what you think might actually happen.
Well, I would say that there's such a wide spectrum of people getting into Bitcoin. There's people that have never, or think it's, it's not backed by anything. Like I've had so many of those conversations, and there's years of education. We usually meet people, there's no doubt they believe in Bitcoin, and now they want to know how to make it productive. And so I would say that on the institutional side, increasingly there'll be a set of, like Sean's company is competing with other companies that they have to show we're going to do something with this. And so I think increasingly there needs to be something productive done with it. I take a lot of issue, like I don't think it should be called yield at all. It's just a bunch of actively managed risk. Also on the, I think on the dollar yield side as well, there's even, Athena recently went from this basis trade, which has died because institutions have entered, and now they're basically a multi-strategy hedge fund. And so I wouldn't go to a multi-strategy hedge fund for my yield. I would go to a treasury bill, right? And so I think that some of this has to do with how we label different products. And it really goes, you have this DeFi group that there's a lot of money in it, and there's mislabeling. There's just people like headline, oh, it's an X% return on my Bitcoin, sounds great, and there's so many layers of risk people don't know about. They don't even know what to ask about, and those risks even shift over time. And so I guess to answer your question, I think that you'll get increasing stratification of how the industry matures. Just like, we do lending too, right? But we originate the loan, we service the loan, we have a platform that monitors risk in the loan, we fund the loan. Those are, in mortgages, those are all separate, entire multi-billion-dollar businesses. And so I think in all of these things, you'll see greater stratification of products and people that are better matched to specific things and advisors that know where to steer people. But most, I think, money is more institutional, and it'll probably gravitate towards some kind of active management one way or another.
Yeah, I just wanted to add, I agree with all of that, actually. I think that's exactly right. It does change how you interpret the market. One thing I'll say about last year is a lot of people were wondering why Bitcoin went down when there were so many institutional flows and then long-term selling was actually relatively limited. Part of that was that there was this sort of echo selling through option overlay strategies that was really significant. We run that business, you run some business, everyone, there was just a lot of it. And I think as you see more of these active strategies on top of Bitcoin, you're gonna have to change how you view transfer metrics, because there's a lot of forward selling of Bitcoin occurring even while the Bitcoin is not moving. I do think it changes, and people didn't catch up with that last year.
That makes sense. Definitely, I think it does require that mental model shift. This one's just like a general question for the audience here. One last maybe structural question before we start closing. Traditional markets today run on pretty much clearinghouses and central counterparties. Arguably, for a period of time, crypto did have a version of it, probably in the guise of like Silvergate Exchange Network or Signature Bank, as an example. Obviously, they predominantly were on the fiat side, but still, we did have these kind of like central choke points. What's unique about the crypto side is we don't necessarily have a lot of these central points anymore. And I'm curious, is this a feature? Is this a bug? Should we actually expect many more central clearinghouses and counterparties to actually materially actually arrive, or will it actually be again hyper fragmented and decentralized to a certain extent?
That's a tough one. I mean, I would say that we're starting to see some of the traditional TradFi folks enter the space, right? You have Bank of New York now offering custody. There's Goldman is doing swaps. So there's you're starting to see them kind of percolate in, but I would expect that it's always going to be kind of a pretty diverse group of players. I think the folks like yourselves at BitGo or some of the early players have a big head start, and so I think as this adoption gets more embraced by institutional market. I'm sure you guys are picking up a lot of institutional business through this, right? But I do think it's actually probably good for everyone, including BitGo, to have that kind of that social proof of, okay, Boney, all right, Bank of New York, we got to get into the business. We've been staying out of it, but now we're showing up, And so to me, it's I think there's just so many different opportunities in the space. I mean, I look at the mortgages that Milo does with the Bitcoin-backed mortgages. And I look at what you guys do over at 2Prime with, option overlays, and more interesting, the asset-based lending side, right? Where, this is just really almost like early days of high yield bonds, right? It's you're getting a lot of excess spread over the amount of risk that you're embracing. It's a 24/7 liquid market. I don't want to do your sales pitch for you, but it's a 24/7 liquid market, right? Like if somebody's going to default on their Bitcoin loan, you have the Bitcoin. And, to me, that should be, much more tightly priced than where it is. I think, you guys have brought those spreads down a lot, but, I think there's still really a great risk reward. So, but I think the industry's evolving. I think now we're seeing the traditional players, that are showing up, and there's always room for a lot of different, you got your PIMCos, your double lines, your WAMCos, your capital groups. So there's going to be a lot of different players in the space.
Got it. So net, no DTCC with 99 point, I guess technically 100% market share, nothing like that, but a world where there's many, many different players all playing a hyper specialized role. I think that makes sense. That definitely seems to be
hopefully no DTCC type.
Yeah.
I think it's a regulatory question. Right? In an open market, it'll tend towards an oligopoly with a very long tail. That's what you see in media. That's what you see in other open markets. That's what you see in crypto. And so that's what I would expect. But there is, of course, always the opportunity for a regulator to come in and impose. Right.
Like I said, look at what's the right analog asset? It's probably not a stock. It's probably gold. And so I think you have all these different flavors from ETFs to physical gold to tokenized gold. And I guess who's central to all of it is really the logistics and custodians of it, right? Like Loomis or Brinks or something like that. And it's really this bearer asset that really comes down to who can I freaking trust not to lose this for me. And most people don't want to hold it themselves. So I would think that it would stay somewhat not as consolidated as the DTCC.
Yeah. Although let me share a fun fact about gold for all the self-custody Bitcoin people out there, specific to ETFs. When the gold ETF launched, everyone was worried that no one would want to hold physical gold. And actually what happened is the number of people who held physical gold exploded because the ETF legitimized gold as a major holding period. The pie got much bigger. And I think the same thing will happen in Bitcoin. So for sure, a lot of people will own it through ETFs, but I suspect the number of people who self-custody will be 10 or 100x more than it is today in 10 years because ETFs and the institutionalization are just pushing it to a much broader audience.
That's awesome. Grow the pie. Grow the pie.
One more fun fact on that. I mean, you guys probably all saw gold is overtaking the dollar as the major reserve asset of central banks now. Like that's the first time we've seen that in a long time. So, I mean, again, if Bitcoin kind of functions like digital gold, a really good tailwind here, I think.
Awesome times.
I have a question, Matt. I wanted to ask you, do you think that, or counterpoint to that would be that the threat of quantum would actually move people into the ETFs?
I think that's a really interesting point. I think that's possible. That's like a one-time, right? But it is a one-time. I think that's reasonable. I think that's a good point. Quantum is a big thing looming out there for sure.
Yeah, we're doing a lot of research on quantum at Blockstream. I think we were cited, quite a bit in the Google papers and the Caltech papers. And, it is really important to realize that, this is all theoretical still. Like it's not here yet, the physical. And, can they get there, by 2029, 2030? Maybe. But there are, I think the one thing that I think makes the community nervous is this bystander bias where people maybe are like, oh, you'll take care of it. Or, oh, you'll take care of it. And it doesn't get taken care of, right? But there are people working on it.
We definitely don't want it to be the Spider-Man meme of like, I thought you were handling it and I thought you were handling it. The good news is BitGo is definitely working on it right now. And hopefully we have some good stuff to share on that front. All right.
I would say quickly about the quantum stuff. I think in some sense it's not really about quantum. It's that the quantum question raises uncomfortable questions for Bitcoin in general. Like the fact there's really like 12 dudes who run the code for Bitcoin. It's marketed as this super decentralized thing, but anybody can make a fork. But in reality, if you don't have the consensus of a couple key people, you're not going to get very far or listened to. And so like what we do with Satoshi's coins, there's not a black or white. It's a subjective question that needs to be decided by humans, but you're marketing a product that is supposed to have no human influence. And so I think that's really what it highlights is there is a human element to Bitcoin and who controls the code, who controls the nodes. Just like Bitcoin trades like a risk asset because people consider it one regardless of the limited cap and all that stuff. And so I think quantum like touches on this unspoken part of the way Bitcoin really operates.
Whether it's truly credibly neutral. Yeah, very good point. All right, let's have some fun. So we're going to go into a lightning round. Quick answers, one each. Some questions might be a yes or no. Some questions might be pick one of the following that I mentioned or a fill in the blank. So whatever you think is actually the most appropriate answer. We'll start with a very kind of easy one, hopefully non-controversial. Should be very straightforward. Bitcoin ETFs, do they hold more or less than 1.3 million Bitcoin by year end?
More, because I think they become a sticky point for some of the wealth management and advisors adopting Bitcoin ETFs. And as long as you include them in your portfolio, it takes time, as we learned today. But the moment that you include them in the portfolio, they become a sticking point, and then you continue to recur the growth, the volume. So yes, more.
Yeah.
First of all, when I was a kid, if someone said, what would be fun is guessing Bitcoin ETF numbers, I would have said, you made a wrong turn, dude. But I would say, I think right now it's about 800,000 in ETFs, or is that just BlackRock? I'm not sure. Do you know? Total in
I
ETFs?
should know the number. I don't know the number.
No, MicroStrategy just overtook BlackRock
Yeah.
at 817. So
I think
So-
it's probably north of that.
Maybe there's like a 1 or 1.1 million. So I think 20% growth by the end of the year probably is reasonable.
Some more.
Yeah. I mean, Schwab's out there saying 7% Bitcoin in your portfolio, so I think it's coming in.
Yeah, I agree. I own your ETF, so I think we were kind of at the bottom of the retail, kind of the kind of the sell-off that we saw here at that 60K, 200-week moving average. So I think a lot of people will come in through the ETFs.
Awesome. Slightly related. In 1 year, will most new institutional Bitcoin inflows and exposure come through ETFs, direct spot, treasury companies, structured products? Fill in the blank.
Banks.
Banks. Okay.
Yeah.
All right. Interesting.
I would say ETFs.
ETFs.
Yeah, I'm going to talk my book. It's the ETFs.
For ETFs.
Even as a treasury company, I would still say it's ETFs first.
All right. ETFs. It is. Okay. Clarity Act signed into law by 1 year from now. Yes or no?
Yes.
I don't think so.
No.
If it's not done by November, it's over.
Yeah. I mean, like another 2 years, right? And regime change is definitely gonna happen. Stablecoin yield. Obviously, there's like the current state of stablecoin yield, but like if you were to again fast forward like 2 to 3 years, like, will we see a world where the yield is actually able to be distributed back, or will it be this kind of like neutered version of what currently exists?
We're going to see a version that we cannot think of today. It's going to be a narrow representation of what is allowed to offer in the yield space. But it's going to be there, but very limited.
Yeah, I could say so much about this, but I would agree there's going to be a limited controlled thing to protect people and maybe protect banks to some degree. That probably is a good middle ground.
Yeah. Yield is like water. It'll flow downhill. And at some point, the profits going to the banks will be just too large and it'll get broken.
Yeah, I would agree. I mean, I think that, I think the banks, have a powerful lobby and they're going to delay, but eventually it'll get there.
Okay. Last one. Biggest unlock for institutions over the next 12 months. Is it regulation, custody, liquidity, distribution, other new structured products, or fill in the blank?
I think it's going to be standards. Standards for cross-border payments, standards for interoperability, standards for settlement, because that's going to be the foundation for all the products that we can build on top of that within the banking system.
I'd say probably the Genius Act, it got passed, but for banks to actually integrate that takes years, right? And so I think there's headwinds or tailwinds from that'll probably start to show up over the months and years to come.
I think it's peers. I was speaking with an endowment the other day. They bought Bitcoin. I asked them why. They said because one of their neighboring endowments bought Bitcoin. They didn't want to fall behind. I think it's just being massively normalized. And so I think that's the biggest driver.
Yeah, I would agree. I think it's, you haven't really seen the pensions come in yet. I think the endowments and the foundations are a couple steps ahead. But you're definitely getting on the radar. And so we definitely see what the sovereigns are coming in. So it wouldn't be surprising to me if, the next year or two you start seeing pensions because the big sovereigns got it,
Okay. Last round of questions, I promise. We're in Vegas. We should definitely close out with a bang. Right now, prediction markets are all the rage. The pessimists or the naysayers will say, you're just a bunch of gambling. It's a bunch of like betting. Optimists like me will say, no, it's this thing called an information market. If you could create a prediction market that you yourself would actually like to invest in, what would that market be?
I think, will U.S. banks overtake spot trading and payment volumes on chain over crypto exchanges by 2027?
Oh, interesting. Wow, very specific, very hyper specific. Someone make that market right now.
That's how you do it.
Maybe, will Bitcoin ETFs grow more than gold ETFs over the next 10 years? Something like that? I'd vote yes.
Can I make a statement in favor of prediction markets and then answer the question?
Absolutely.
They also said options were gambling. They said corporations, limited liability corporations, when those were created, were gambling. They said ETFs were gambling when they launched, and they definitely said crypto was gambling when they launched. That's what they say about every major new financial innovation, and then you realize it has major applications. So that's my pro prediction market speech. I think there's so much to do. I would love to see people wrap sort of CDS style exposures into prediction markets to hedge out specific risks. Could you have a prediction market on strategy freezing the streak dividend? Would that be interesting? I think that would be interesting. So I think there are whole new categories of prediction markets that we haven't even seen yet.
Awesome.
Yes, if I was going to look at one, I'd say, a prediction market with could Bitcoin overtake gold in market cap in the next 10 years. It'd be kind of interesting.
Awesome.
Take the over.
Yeah, absolutely. So there you have it. 4 amazing panelists. Thank you guys so much for your time. Please give them a round of applause.
Thank you.
And that wraps.